Support and resistance are not some fancy lines on a chart. They're actually people stuck with money on the line, just like you see here in front of me. Let me help you spot it by just reading the option chain. Hi, I am Pranav VK and welcome back to Stockshaala by Kotak Securities. In this video, we're going to understand how to spot support and resistance using option chain. In the previous video, we understood what exactly an option chain is, and we know that option chain is represented by option sellers because option sellers create option contracts. What you see in front of me is stacks of chips which represents call option open interest as well as put option open interest. Call option open interest represents resistance, whereas put option open interest represents support. So let's simplify it and understand this better. Option writers want their contracts to expire worthless because let's go back a little bit and understand what exactly and how exactly an option seller makes money. We know that when an option seller sells a contract, he is selling at a higher premium, and when he closes the contract, he is buying back at a lower premium. For example, let's say a 25,000 Nifty call option contract is trading with a premium of rupees 100. And now imagine that I am the call option seller and I have sold this specific contract. Now if the premium goes from 100 rupees to 50 rupees, then I am gaining a profit of 50 rupees. But at the same time, if the premium starts going higher from 100 to 105 and 110, then that is when I start making losses. So in this case, if 100 becomes 0, then as an option seller, I am able to gain the entire 100 rupees premium as profit. So in this example, we understood that as an option seller, we want the contract to expire worthless. So wherever there is huge open interest, so in this case, this one has the highest open interest, and let's assume that this is 25,000 call option. If this has highest open interest, then the option seller doesn't want the market to breach this level and go above 25,000. And only in this case, the option seller is going to make the complete profit. Think of it like sandbags in a flood. So option writers stack up these sandbags, that is your open interest, so that this specific level is not breached. And similarly, as and when we go away from the at the money, then we can also see that the open interest goes on reducing, which means the resistance or the support is also not that strong enough. And once it breaches the highest OI, that is open interest level, either on the call option side or on the put option side, then there are chances that the market might start moving in either direction. So let's have a real life example by heading to the whiteboard. Here I have Nifty, which is trading at right now 19,500, which is the spot price. And we have various strikes on the left hand side as well as on the right hand side. 19,400 has the highest put open interest, whereas 19,600 has the highest call open interest. So since 19,400 has the highest put OI, this will act as a possible support, whereas 19,600 has the highest call option open interest, which will act as a possible resistance. Support is where put writers or put sellers are defending the wall, whereas resistance is where call option sellers or call writers are standing strong. Now let's take this one notch higher and understand more about this. Imagine now that we have 5 lakh open interest on the put option side for the 19,400, whereas 19,600 has 8 lakh call open interest contracts. It's not always about how many contracts are already there, but it is also about how it is changing dynamically at every moment. Which means that, let's say, the 5 lakh contracts have started reducing and it has gone down to 4 lakh contracts, which means 1 lakh people have closed down the contracts. Whereas if 8 lakh contracts increases to 10 lakh contracts in the same time, it means that the number of contracts has increased by 2 lakhs, which also means that the resistance is increasing and the support is weakening. So think of it like a fortress. If they start adding more and more troops to the wall, then the wall becomes stronger. But whereas if the troops start leaving the wall, it means that it's becoming more and more vulnerable. Here are a few common mistakes that you must avoid while using open interest. The first one is don't use open interest independently for taking trades, but rather combine it with price action. The second common mistake is that near expiry, traders use open interest and only rely on it for taking trades. But rather, that's a very big mistake, because near expiry, the open interest might just shift in a moment's time, and that will flip the coin in a moment's time as well. And final and most importantly, avoid zones where there is confusing OI on both the sides. Neutralize the strikes which has similar call and put OI, but whereas focus on where there is imbalance. Now let's look at open interest on a live platform. Here in this platform, you can look at the open interest. I have chosen the expiry date of Tuesday, that is 7th October. And then we also have open interest change. We have multiple strikes here. The green represents the put open interest, whereas the red represents the call open interest. You can see here that the total call OI is 22.38 crores, whereas the total put OI has 27.68 crores, which represents that there is stronger support than resistance and the market is expected to be bullish. But remember that near expiries, this can change very fast. And that is why looking at OI change becomes a very important parameter, where you can actually observe how it has changed in the last 5 minutes, how it has changed in the last 10 minutes, 1 hour, and so on. So here are two key highlights. First one is that if there is highest OI zone, then it means that is a very key level. And the second is that if there is maximum change in OI in a specific strike, that means that big players are reacting to it. Support and resistance are not magic lines. They are lines created by fear, greed, as well as big money. Let's summarize what we have learned so far on the whiteboard. So here I have put the indicator, the meaning, as well as the implication. Starting with the first one, if there is high put option open interest, it means that there is support and bulls are trying to defend that specific level. If there is high call open interest, it means there is very high resistance and bears are trying to defend that specific level. If put OI is increasing, it means that the support is becoming stronger and stronger, whereas at the same time, if call OI is decreasing, it means that the resistance is becoming weaker. The vice versa is also true. If put OI is decreasing, then it means the support is weakening. Whereas if call OI is increasing, it means that the resistance is becoming stronger. And a shifting OI represents a shifting sentiment in the market. Now that you have learned how to analyze the battlefield, you are now ready to go and plan your trades like a pro. In the upcoming videos, we are going to learn multi-leg strategies, spreads, and go deeper into understanding how they can be used for risk management as well as leverage. You are watching Stockshaala by Kotak Securities. I am Pranav VK. Go ahead and share this with your friends and put the comments in the comment section. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.